Michael Burry, of The Big Short fame, reduced his U.S. stock portfolio to a single position in the second quarter, according to a Securities and Exchange Commission report on Monday. Burry's Scion Asset Management reported a stake in Geo Group worth $3.3 million. Burry's close supporters are likely to see his move to basically sell his assets as a negative sign. The hedge fund manager diagnosed the greatest speculative bubble of all time in all things last summer and said owners of meme stocks and cryptocurrencies were careening toward the mother of all crashes. Most recently, he warned investors not to get too happy about the current stock comeback, pointing out that prior downturns saw several transitory rallies before reaching a bottom. So let's start the story from the very beginning. Why stock prices fluctuate. Stock prices fluctuate in short term due to the law of supply and demand. Every day, billions of shares of stock are purchased and sold, and it is this buying and selling that determines stock values. Assume 1,000 individuals are willing to buy one share of stock, XYZ, for $10, but only 500 people are willing to sell one share of XYZ for $10. The first 500 customers will each receive a share for $10. The remaining 500 purchasers boost their offer price to $10.50 after being excluded. This increased offer price persuades some XYZ owners who were previously unwilling to sell at $10 to sell at $10.50. Since that time, the stock price has risen to $10.50 from $10. A stock's price rises when there's a large demand for it, but what produces that high demand in the first place? It all comes down to how investors perceive the stock market's attitude, the market's attitude toward the industry, market perception of the stock market, and economic self-assurance. The more optimistic investors are about a company's prospects or the possibility of favorable events, the more probable it is that they will desire the stock. A lack of confidence, on the other hand, might cause investors to sell, lowering the stock price. Quarterly earnings reports that exceed or fall short of expectations, analyst upgrades or downgrades, and good or negative company events can all have an impact on stock sentiment. Sentiment toward a specific industry may also influence stock demand. For example, an electric vehicle company's stock price may skyrocket as investors pick up shares because they believe in the EV industry's future. All boats may be lifted by a rising tide. This is true in both directions. If investors lose faith in an industry, every stock in that industry may fall, irrespective to how well each individual firm performs. Stock market confidence may also increase demand and prices for particular equities. If investors feel that stocks are a good investment, either because valuations are favorable or because the stock market has been heading upward, an increase in demand for equities can lead prices to rise across the board. The inverse is also true. A falling stock market can erode investor confidence, resulting in greater selling and lower stock prices, whereas high valuations may cause some investors to buy fewer stocks or sell their holdings. Stock prices are also influenced by opinions about the economy's trajectory. In anticipation of an economic downturn, investors may sell some equities. On the other hand, there's a widespread conviction in a rebounding or flourishing economy. Why do stock prices fluctuate by the second? In the near term, supply and demand push stock prices up and down, and the supply-demand balance is influenced by market mood. However, investors do not alter their minds every second, so why do stock values fluctuate so quickly? The current stock price merely corresponds to the price of the most recent transaction. Many equities have transactions every second the stock market is open. Every day, investors exchange 90 million shares of Apple. When a block of shares is bought and sold, the stock price adjusts to reflect the most recent transaction price. Because of the volume of transactions, the stock price varies every second. Is the U.S. stock market's summer surge over? If so, was it a bear market rebound or a minor hiccup in what appears to be a fresh bull run? In any case, the S&P 500, NASDAQ, and Dow are all set to fall, with the S&P 500 ending a 4-week winning run as earnings season concludes. If I were to look at the S&P 500 today, it would be easy to say that this was a bear market rally. It showed weakness closing into today, states Linda Garcia, founder of In Luz We Trust, a financial community geared towards Latinx investors. This is when we want to see it at least sustain the gains it gave us through the week, and it's gone. This month, investors are focusing on remarks from Federal Reserve Chairman Jerome Powell, who suggested that more interest rate rises were on the way. There's a disagreement over how much higher the rises will go, giving investors pause and resulting to an overall calming tendency in the market. However, it will not endure long. Powell is scheduled to appear at the annual Global Central Banking Conference next week, and the Fed continues meetings next month, when the next rate hike is possible. For the time being, investors are clinging on to their hard-earned optimism following June's fall, which might represent the market's bottom if a bull market resumes. Only time will tell. Are we in a downturn? Yes, by technical and historical definitions, we are in a recession, Garcia says. The nuances are what can trip people up. But pushing the job market aside, we are in a recession. The United States GDP declined in the previous 2 quarters, matching the definition of a recession. But with a solid job market and high consumer spending, it's difficult to label it official recession. As a result, the market is in a state of flux, according to Garcia. Furthermore, now is an excellent moment to begin investing in the stock market, especially if you've been sitting on the sidelines for a while. As per Garcia, this is a really great opportunity for folks to either start learning about the market, start participating, or continue to be diligent in their monthly investments into the stock market. Regardless what the market does, the best course of action is to adhere to your strategy and continue investing. Ups and downs are a normal part of the investment cycle, and right now is an opportune time to continue dollar cost averaging in broad market index funds at a reduced cost base. Will the stock market heal? With rising interest rates, continued geopolitical strife, and increasing consumer costs owing to inflation, the stock market has been on a wild ride this year. According to analysts, the market may yet fall lower, despite the fact that the previous few weeks have tentatively seemed like the start of a comeback. Keep in mind that even with the market's typical ups and downs, investments easily surpass inflation over time. Regardless of what the market is doing, the greatest answer for an investor is to maintain the course and maintain investing. The market is forward-looking, Garcia mentions. This is the time where we lean into the market, knowing something that we don't collectively. According to Garcia, traditionally, the market has almost always rebounded, and by the time we label it a recession, we're already digging our way out. How should investors handle stock market volatility? Large market fluctuations might be overwhelming for rookie investors. There's a lot of uncertainty right now as a result of interest rate rises, rising real estate prices, and ordinary items becoming more costly due to inflation, and the market reflects that on a daily basis. However, if you have a buy and hold strategy that includes low-cost broad market index funds, keep in mind that slow and steady wins the race. Portfolios with the most market time have the best performance. Invest early and frequently, especially if you have a long investing horizon. Dips and crashes will occur, as will other frightening-sounding events such as economic bubbles, bear markets, corrections, death crosses, and recessions. You can even take advantage of a downturn to invest extra, but only if it doesn't interfere with your usual investment timetable, according to experts. It's difficult to predict when the market will fall or correct, and not even the finest investors in history can time the market. The greatest advice is to adhere to your own goal and continue to invest. What counts in the larger picture? Long-term investors, such as those at the Motley Fool, are unconcerned by the short-term events that drive stock prices up and down each trading day. Analyst reports and profit beats are typically transient and useless when you have years or even decades to let your money grow. What counts is where a firm will be in 5, 10, or 20 years. In the long run, the value of a stock is ultimately linked to the company's cash flows over time. Investors who believe a company's earnings will rise in the long run, or who think a stock is cheap, may be ready to pay more for the stock today, regardless of short-term developments. This provides a pool of demand that is unaffected by daily news, which can propel the stock price upward or prevent large losses. While much ink is spent over daily variations in stock prices, and many individuals try to profit from such short-term moves, long-term investors should be laser-focused on a company's ability to expand earnings over time. Ultimately, increased earnings drive up stock values.